What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are just kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. Today, I'm joined with engineer Amanda Larson. How you doing today, Amanda?
I'm great, Dan. How are you?
I'm fantastic. And not only that, I got some great news for you. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here today? Well, obviously, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors. That means operators. It means investors. And you may ask yourself, why would you want to do that? And the answer is, if you've ever heard of the off-market private deals you're not supposed to publicly discuss, sometimes they're called 506B deals, then you should also know that you should have your documentation straight of your prior substantive relationship, or else the SEC will get ants in their pants, and that could mean that they're going to take your business away. So that's what I'm finding out right here, and the benefit to you is you will learn not only how to more effectively communicate on the subject of commercial real estate deals, but you'll also understand how my guest fits into those deals. But before we get too excited about real estate, Amanda, do you want to say a thing or two about yourself?
Yeah, great introduction. Thank you so much for having me, Dan. I love what you're doing. So we don't want the SEC to get ants in their pants. So thank you for helping me out with that. Yeah, quick introduction. I'm Amanda Larson, former engineer, turned real estate investor, founder of Alma X Equity. And we operate and raise capital for multifamily apartments, primarily in Texas, but we're open to venturing out beyond the great state of Texas and those borders. So yeah, thank you again for having me. And I think it's gonna be a lot of fun.
Awesome. My pleasure. We're going to start off with the first segment, which is about motivations. But before that, I got to say, but wait, check your 8. Now, Amanda, I don't know if you know how to do this or not, but maybe you can see through the camera and down into the user's device. There might be this hideous subscribe button that they haven't hit. And if they have any Generation Z people in the house, they'll get all judgmental, be like, I thought I knew you, all that. Okay, it's a dumb joke, but whatever. It's one that I've now done a gazillion times. But let's talk about motivations. When real estate people are meeting each other and being really prudent, they really ought to find out, hey, what's bringing you to this business, and more importantly, what's keeping you from throwing in the towel when the going gets tough. And at this point, I've now interviewed hundreds of different investors and syndicators and deal sponsors, and everybody obviously has their own unique reason why they do it. But I found that they fit pretty neatly into these 5 categories. The first one of which is preservation of purchasing power. What on earth is that? Well, some people, they either make more money than they can actually spend, so they always have to be putting away money in the form of investments. Other people, they're completely W-2 or job optional. And the way that those people pay their bills is from the proceeds of ownership. They have a portfolio of assets, and whatever profits come from that is how they make ends meet. But if you're in that situation, if you're just imagining what it would be like, you might think, well, why would you bother making another acquisition? Because after all, they take months to close, they take years to go full cycle. And so why would somebody like that want to make another deal? Well, there's a couple big scenarios that stand out. One of them is if inflation rears its ugly head, then that's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. The other situation is when you're buying at a very steep discount. And the idea there, because everybody should be trying to get the biggest deep discount they can, but at least in that situation, they're not going to pull the trigger unless that discount is in place. So they're not as transactional as some people in this industry. And as enviable as that sounds, I confess this is not where I am in my real estate career yet. What describes me better is trading time directly for wealth. Basically, I put my thinking cap on as a person who came from tech. I'm originally from electrical engineering, but I
Me
ended
too.
up working for. Right, nice, nice. Yeah, so I ended up working for a CRM company, and when I found out that it didn't really have much of a future for more or less outsiders such as myself, I ended
Mhm.
up creating my own CRM agency, focusing on online funnels, API integrations, and all that kind of stuff for whatever seven-figure or higher online businesses I could find. But of course, as you look for bigger and better clients, all roads lead to real estate, I've found. And
Yep.
so I got hired on by a guy who was flipping 10 houses a month. He was doing 10 single family transactions per month and making money hand over fist, especially compared to a guy like me. So it hit me. It's like, I really need to pivot. And instead of focusing on high salary, high wage, and high
Mhm.
tax burden, I should pivot into being rewarded in the form of deployed capital, aka wealth. So that's what I'm up to. And I get that that's not really for everybody. It's a little bit abstract, especially for youngsters, but that's the truth. More accurately, for youngsters in general, a lot of people, they want to hustle like crazy right now so that they can fast track their retirement. Other people who aren't quite so young, they're more interested in taking control of their schedule, being able to make sure that
Mhm.
they can do the things that they want to when those pop up, or maybe they just want to work fewer hours per week or fewer months per year or something like that. But this is a big motivation for a lot of people. And the mistake that some people make is thinking that this is secretly what everybody wants to do. But I assure you, especially in real estate, that's simply not the case. Like, some people are fueled by ambition. They want to buy their
Mhm.
entire hometown. They want that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. Now, of course, in some circles, that's vilified. But I think that if you understand that properties need somebody who's not asleep at the wheel, who's actually got lots of
Mhm.
hustle in them, that's what makes these nicer places to live or rent.
Yeah.
And so it's important to have somebody who has that more or less independent motivation in order to make things work. Now, the other type of person who's going to be hustling into their 90s, they're not so much focused on their own generational wealth so much as some sector of society, or maybe it's the environment or animals, something like that. Maybe they want to send people to space. Regardless of what it is, if you want to make a really big impact in society, there's a massive financial component to that. And that's why some people make these commercial real estate acquisitions. So, Amanda, of those five different motivations, what combination of them would you say describes you best?
Oh, great question. I like them all, and I think, yeah, I think these are the most common for me. I would say that for me, it's not necessarily fast tracking retirement, but it's having additional streams of income and seeing the opportunity to be able to make more and have a better life than when I was doing chasing a 95, 9 to 5. I was in a very cyclical industry as an engineer, and as hard as I tried to, get my career jump started and, take off and get those promotions, the cyclicality just, I was just always getting set back. And I got around some real estate investors, and I was like, wow, these guys are doing some really big things and they seem to have more control over their time. Granted, they are still hustling. It's not passive, it's very active when you're on the general partner side, so it's not easy, but they were in control of their future, their financial future, and they just seemed to have it kind of put together. And the more I got into it, I actually found it really interesting. So I just kept following that path, and here I am today.
I love it. I love it. And of
Yeah.
course, one of the issues of discussing motivation is there's the chance that you come off sounding overly optimistic, not
Mhm.
recognizing the risks. Amanda, you did a great job of that. But my next question, it's a little bit of a wet blanket on that sort of starry-eyed view. It's the tolerance for risk assessment. And if you've ever been involved in a 506B syndication, those are
Mhm.
the deals where you're not allowed to publicly discuss them. So it's probably an off-market deal, these private deals.
Mhm.
Well, whoever the securities attorney in the mix was, and there really should have been one because
Yep.
otherwise that's a huge, huge, huge red flag that it might be a Ponzi scheme. But the securities attorney should have insisted that everybody involved fills out this super duper invasive financial questionnaire, like questions like, what's your net worth, what's your investing history, and the asset classes you focused in. And that's no fun. But the bigger, more problematic part of that questionnaire, in my view, was the tolerance for risk assessment question. It was a multiple choice question, and I felt that it didn't matter which one of those answers you chose, it lacked utility. I couldn't really use it and depend on your reply. So I made my own one, which is a fill in the blanks question. It is: there are many popular investment asset classes, but I think blank is too risky. So Amanda, it can be inside real estate, it could be outside of real estate. What's too risky for you?
I would say right now, I mean, there's a lot of things that I just am not familiar with, but right now, I'm going to say investing in Chinese real estate would be pretty risky for me.
Very fair. Very fair on
Get
that
on the
one.
real
Yeah,
estate
yeah.
track.
I lived in
Yeah.
Taiwan. Right, right. Yeah, I lived in Taiwan for 15 years, so I was watching it as the boom was going on, and I've been aware of these ghost towns for a
Wow.
while, ghost cities, whatever you want to call them. So yeah, I think that's very, very fair. Just heavy, heavy, heavy leveraging and people building buildings where there's another one that's opening up across the street that has, it's going to be cheaper
Yep.
and it's exactly the same. It's oh, what a disaster. So I love that answer. But that brings me to the next question, which it's about the favorite deal metrics. Now, of course,
Mhm.
Amanda has a background in engineering, which means I know she's not allergic to numbers, which is
Mhm.
always very, very reassuring. But originally, for the first few hundred chance encounters, I wanted to include this slide, but I didn't because some people are more front of house. They're the public face of the
Okay.
company, and they're not the type of person who's comfortable doing a deep dive into a spreadsheet. And so I
Mhm.
felt it's like a little bit unfair for me to asking what kind of deal metrics are most important to you, especially if they're deal agnostic and depending on their sponsors. But I
Mhm.
found that even if they are just investor relations and that sort of piece of the puzzle, there's still going to be a few deal metrics that they rely on. So I
Mhm.
decided to bite the bullet and include it. So I've got 14 of them on the screen right now. And for anybody in the audience who's only listening and not watching, I read them out. The first one of which is cash on cash, then IRR, which is internal rate of return. Then we have cost per door. We have net operating income. We have the going in cap rate, which is really to say what the discount is compared to the local properties to that property. Then there's the
Mhm.
loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy rate, which is the inverse of the vacancy rate. So it's the same number reflected a different way. Then there's the average income where the property is located, the amortization period of the loan, especially if you're going to be assuming it. Then there's the difference between the market and the in-place rents. There's the population growth where the property is located. So you have some baked in demand right there. There's the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now. Then there's the waterfall, split, or exit strategy, which is about what's going to happen to your investment after your principal has been returned. And lastly, I have DSCR, which is debt service coverage ratio, which is what proportion of the revenue from rents and whatnot is going right out the door immediately just to pay for the loan. Now, of course, this is not a comprehensive list. It's not an exhaustive list. So,
Mhm.
Amanda, if there are other metrics that you prefer to rely on, go ahead and say that. But you want to give a top three or something like that?
No, I think this is a good start, definitely, and I like how you don't rely on just one. I see some investors take one that they're most familiar with or that they heard on a show or something, and they just laser focus on that. And what the truth of the matter is, it's a combination of many that really tell the story of the deal and if it's suitable for you. So if I were to pick maybe just a few, I would say that on the general partner side, before we even look at a deal, we look at average income and population growth. So that is taken care of right away for even something that we would underwrite. Average income, to give an idea, would be around $50,000 average income. The more the better in most cases. And then population growth, you just want to be in a market that's sustainable and it's growing and has a variety of employment sources and things like that. What I see a lot of, what we also focus on, almost simply because our investors really focus on it, is IRR. It's something that our investors like to see. Right now, it's around 16 to 17% is what's needed to get a deal over the line. And then, of course, I would say next in line would be debt service coverage ratio, because if you can't pay your debt service, as we are seeing in some troubled instances right now, it's, you can't sustain for long with negative cash flow. So those would be my main points to focus on. And then sponsor record.
I love it. I love
sponsor
it.
record. You got to know your GP.
Right.
You have to know your sponsor. You have to like them, trust them. What have they done? Yeah.
Yeah, I love the answers that you hone right into, because it really reminds me of, like, I view a lot of these just like physics, where you've got forces, and if it's a non-zero force, it's gonna give one day. You just have to basically be reinforcing and reinforcing and reinforcing, and if you let it slip, it's gonna be a deluge. So I'm just eating up that answer like a delicious subscribe sandwich, which I have on there. Is that intense as what or what? But it reminds me, it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different roles in a commercial real estate deal. And the main reason why it's so important to include this in every episode is because, one, effectively communicating on the subject of a commercial real estate deal is going to dictate your success in this industry. If you can't explain what it is you do and how you're going to actually build this team and make it work, then I think you're at an enormous disadvantage. And the other benefit is it helps you understand how my guest fits into those deals. And as you're watching, if you're sitting there thinking, you know what, I really need to get me one of those cubes. Well, the great news is it's absolutely free. If you go to dandoesdeals.com, there's this great big conspicuous button that tells you just click here, and it brings you straight to the PDF, and you can download it and print it out. You can try it on your friends and family and all that kind of stuff. And yes, you heard me right. I committed the cardinal sin of marketing, which is you never give away your freebie without asking for some sort of contact information, like an email or something like that. But I know people like you, engineers and whatnot, you don't need more spam. So that's why I did this for you, because it's just so important to your future. So let's go through the 6 sides, starting with the repositioner. What's a repositioner? Well, most of the people who you see in this industry are going to be repositioners. Their job is to look at a gazillion different properties, do a whole whack of different paperwork. And what kind of paperwork are they doing? Well, first they need to underwrite the deal, which is the fancy word for doing the math, doing the arithmetic, because you need to find out, first of all, is this property even making the amount of money that the seller/broker is claiming it is? Because
Nope.
Right, exactly. Yeah, like you were saying earlier with the different metrics, right? Like there are people out there who rely on cash, and it's like, well, are they telling the truth?
Yeah.
If you're only relying on one metric and you're not even sure, that's just terrifying. But anyways, the repositioners. Right. It's pretty much the same thing, right? But the most peculiar part of being a repositioner definitely has to be the emphasis on financier relations. Every repositioner has to have a whole whack of different financiers. In other words, people who they're not responsible for dealing with maintenance or the tenants themselves or anything like that. They only deal with the owners of the property and paperwork and money, and that's it. But the repositioners have to have extensive financier relations, because if they can secure a more advantageous loan, aka cheaper money, that goes straight to the profitability of the building because the DSCR drops. So that's why all of these repositioners are constantly talking to people who they've got something better to do than actually run buildings, but they definitely are interested in making their money work for them. So that's what that's all about. But the more traditional spot that repositioners have to take care of is they have to get an operations team involved and figure out where those Benjamins are going down those toilets and stopping that. But of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and all that kind of fun stuff. Me personally, when I'm on a GP team on a commercial real estate building, one of my biggest contributions are any kind of web-based assets and that sort of thing. And the other one that's really important, especially because I've traditionally focused on bigger properties where a guy from the internet like me can actually contribute, and that contribution would be, even though you're probably outsourcing the property management to a third party, if you've got a vacancy rate problem, which is the real deal killer, somebody with some serious marketing chops needs to step in and get those units filled. And so those are what I tend to contribute to those different deals. But there's only so much wiggle room you have in making the operations more efficient. So the next place that the repositioner will look is they'll get a contractor team involved to do a value add, to make the place nicer and upgrade it. But if only things were that simple. If you're out there gold plating your toilets, then your return on investment is not going to be great. But of course, that's not even the only way that you can lose your shirt just from the construction piece of the puzzle. They can also drag their heels and take too long, or they could use subpar materials that end up having to be redone again way too soon. And that's a big problem. And if you're from the internet, like me, you need locals. You need boots on the ground, somebody who can be there in an hour or two, because I'll tell you categorically, that's not going to be me. I'd still be stuck at an airport in an hour or two. So that's an essential part of your team, to keep an eye on the contractors, to keep an eye on the operators, making sure that they're not sloughing the information that they give and all that kind of stuff. But the last role that's on the cube, I like to do a little bit of a hypothetical to explain what their role is. Let's say you're an engineer or a physician or an attorney or something like that. You own a few rentals and you're like, hey, I know how this works. It's I come up with the down payment and I just borrow the rest. So I bet if I circle my friends and together and say, hey, you know that 350 unit apartment complex down the road? I bet you if we put 100K in each and we went to the bank, we could end up owning that. So why don't we do that? So full of confidence, you run over to the financiers and say something along the line of, I want to buy that building. It's tens of millions of dollars. You don't have, I don't know, say tens of millions of dollars you want to lend us, do you? Well, there's one question that financier is going to be asking you, the banks and lenders in general, that you're probably not going to like, because you might not be eligible for the loan, because they're going to say, who's your sponsor? Who's your KP? What's that all about? At the end of the day, lenders, they get investor money or depositors' cash, and then they lend it out to different operators, syndicators, and whatnot. And they could really give it to anybody who asks. So their criteria is going to be who is not going to take all of this money, make an acquisition, and then run the property into the ground, making it impossible to recover the principal. So that's not okay. So one thing that they require is that somebody in the fold already owns a similar asset. In other words, if you don't have anybody on your team who already owns a 350 unit apartment complex, they're not going to give you the loan for that building. On top of that, you need a certain amount of liquidity to show you can actually run the business effectively. And then between the ownership team, you need a balance sheet, in other words, collateral of at least the amount of the loan. Once you have all those pieces, you got yourself a commercial real estate deal. So Amanda, as far as those different pieces of
Mhm.
the puzzle, I think every engineer likes the asset management piece a little bit too
Mhm.
much, I myself included. I know lots of
Yeah.
people who say that as like it kind of seems like they're giving lip service, but it's so much fun to being able to make those
Mhm.
choices for people. But I don't want to put words in your mouth. Which pieces of the puzzle are you most likely to contribute to your next deal?
Yeah, so I'm one of the persons that does the math. I do the underwriting. I put the business plan together. I invest in Texas, so I'm usually the boots on the ground, and then the asset management. Everyone plays a role, but I enjoy. I came from a project management background, so I kind of can track metrics and crack the whip when I need to. So those are my
Love it.
pieces, and then
Love
of
it.
course everyone plays a role. They put their, in everything. I would say everyone ends up being a capital raiser. Everyone ends up, maybe not on the loan, but it is really a team sport. And so you just add value wherever you can. And I would say that's the best way I can explain it.
Perfect. Yeah, it was excellent. I love that. That's fantastic. So let's talk about the buy box then. When
Mhm.
commercial real estate people or real estate people in general are talking to each other and they say, "Hey, what you looking for? What's your ideal property or what's your buy box?" We're really asking for three main things. First one's geography.
Mhm.
Where is it? Which state, which county, possibly even which neighborhood? For it to really
Yeah.
be ideal, they're going to have an answer for that. The second one's
Mhm.
going to be size. Now, most of my guests on this show, they are in multifamily, which means apartment complex investing. And the way you define size in the industry for apartment complexes is based on the number of apartment units, the unit count. Now, the reason why it's relevant to other investors is because the type of team that regularly takes over 10 or 15 unit apartment complexes, they're going to be fundamentally different from the ones that are focusing on 150, 350, and so on. So that size definitely matters. Now, of course, other forms of commercial real estate, they might not even have units to count. So they might go off of square footage or acreage, but the size issue still absolutely applies. But the
Mhm.
third one is usually called class. And I like to use the term desirability instead because class is clearly separated into two parts, specifically the condition and the area. So if you're talking
Mhm.
about the condition, you're talking about how old is the property, how beat up is the property, how recently renovated it is, and also like what sort of luxuries and amenities it has on site. But if you're talking about the area, the fact that we're talking about apartment complexes pretty often, the residential aspect of it means that the school districts where the property is located is going to be relevant, whereas every other type of real estate is going to have one thing in common, which is the crime rate is going to be very, very important. But the last one is that old trope you hear from brokers of location, location, location. I'm not a fan of that because I don't think it really explains much when what they really mean is traffic, traffic, traffic. If a gazillion people pass by a property every single day, it's going to have more value than one where it's crickets all day, every day. But
Mhm.
both the condition and the area are both, they're defined or ranked the same way as in grade school, where you have A plus at the top, then you have A, then A minus, and then B plus, and so on. So Amanda, as far as your buy box go, what's ideal for you?
Yeah, let's go through them. So geography is Houston, Dallas, and the surrounding suburbs or areas, the metro areas. In terms of class, I also like to think of it in terms of year of construction. Oftentimes the two come hand in hand, not always, but often. And so 1980s or newer is what we focus on, 80s or 90s, and sometimes 70s. And that's simply because in terms of risk, you don't necessarily know what you're getting on those older units. You might not have any problems, but you might have a lot. And so you just without knowing, it's a lot harder to plan for that. And you can only put so many reserves in storage before it kills your deal. So that's the age again. And then location, there's a few things, like you said, that go in terms of location. I like to look at it in terms of accessibility. How quickly can people get to their job or get across town Houston's notorious for terrible traffic, so accessibility is important. Close to good schools, the demographics in terms of median household income is really important, because if you are going to do some upgrades or value add, people need to be able to pay for that value add. I see a lot of sponsors advertising that they can raise rents by $300 a month, but can that neighborhood and the renters in the neighborhood really afford that? That's something that we always look at. And size is another very important one. So we cut it off around 80 units, a little bit flexible, but it needs to be big enough to be able to sustain a full-time property manager and maintenance staff. So usually that 80 to 100 units is the smallest it can be, and still have that crew on site, because I don't fix toilets or air conditioners or anything like that. So I need a team that does that for me.
I hear you. I hear you. Good stuff. I love it. I love it. And so let's talk about people then. And
Yeah.
it's definitely my favorite part of switching over into real estate, because let's face it, in programming and tech and things like that, you get a lot of antisocial people. We tend to be pretty cool with each other, but very distrustful of people who are in marketing or in finance and things like that. But when you're in real estate, I chalk it up to the multifaceted nature of these different deals. Nobody's going to be all six sides of this cube for any meaningful amount of time. People are going to hunker down on what they're good at or what they prefer doing and become great at that. But we're really eager to give referrals, build new teams that we're not even on. But at the same time, we still have our own unique skill sets, which means we're more helpful to others. And even though everybody in real estate is ultimately in the in the business of deploying capital, which means we're always going to be on the lookout for financiers. Me personally, because of my tech and marketing background, the whole real estate influencer thing, the sponsors and KPs are the people who I tend to be able to help more than others, just because they've already got that real estate foundation put together. Whereas when you're first getting started, you need locals or other repositioners who can put in 80 to 120 hours a week, and that's not how I'm at my most effective and making my biggest contribution. So that's not going to be me. But Amanda, if you have any 506B deals, don't go mentioning them specifically in the same sentence of asking for investors. But who's out there in the audience that you're best suited to help?
So I'm best suited to help a financier, people who can come to me and we can work together and take a deal down. So I'm great at finding deals. I can operate deals. But it's, again, getting it over the line and getting all the capital that needs to be put into it. And so that's who I work best with. And that's, I think if there's anyone out there and you want to connect, definitely feel free to reach out, and I'm sure we can find a way to work together.
I love it. I love it. And on that note, we're talking about how to reach out. Me personally, I spend a ton of time on LinkedIn, and I'm fortunate to have this super duper distinct last name. Makes it really easy to find me on LinkedIn. But if you are going to be raising capital, regardless of what kind of business it's for, regardless if it's real estate or otherwise, you really need to make sure you have your securities compliance in order. So if you pause the video, you can scan, it's the same QR code in two different spots here. That goes to the FAQs page of 506BME, which is a platform where we offer the service of backing up and documenting your substantive relations. The idea being, if your laptop falls into the bathtub and the SEC comes knocking asking for your documentation, that's not a good enough excuse. So we've got some tricks up our sleeve to stay ahead of documentation requirements, including removing a lot of instances of plausible deniability. So it's a lot of fun. You can check that out. But Amanda, I know you're also active on LinkedIn. We crossed paths over there. Is LinkedIn the best way to reach you, or is there phone, email, other social media platform?
Well, whatever works best for people. Definitely, I'm active on LinkedIn, so they can connect, follow, DM me for more information. And then if they want to send me email, check out my website. It's almaxequity.com, and the email is just amanda@almaxequity.com. And those are the two best places to find me. I'm somewhat active on some other social media, but not as good as I should be. I'm an engineer, so. Yeah.
Right. It just doesn't seem worth it sometimes. But at least you did the smart move of having the AMAX equity
yeah.
on your screen there. So that's fantastic.
Yeah.
AMAX. Okay, cool. So, but the other thing I have to say before you get going, Amanda, it's actually not talking to you. It's telling the audience. It's my public service announcement. If you.
Okay.
Been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because of the downright hideous subscribe button that you may not have hit yet. And like, honestly, you like, okay, full disclosure, I want a lot of people to click it so that those deadbeats at YouTube actually start paying for these videos instead of me. I think that would be amazing. The trade-off to you, like these days, even having a subscription doesn't even mean that the videos will necessarily show up on your list of suggestions, but that is the only real consequence because it's completely free. But you don't have to pay attention to those suggestions. Quite frankly, I just appreciate the fact that you spent this time with me. Just like Amanda, I appreciate you joining me today. This has been awesome.
And I can say, I'll just chime in and I'll say that this episode has been so informative if you're a new investor. So definitely subscribe. Like, this is adding way more value than a lot of the podcasts and YouTube that I've been on. So a lot of fun. So hit that subscribe, and yeah, you won't regret it.
Awesome. Thanks. Bing. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, well, wherever you're at.